Hello, and welcome to today's video. Regulation of the financial sector always triggers a crass debate. People disagree on whether they think it's a good thing if the financial sector is regulated or not. In fact, it's really controversial because there's a lot more to consider than you might think at first glance. Let yourself be surprised. Would you have thought so? The world of finance is a world full of opportunities, but also full of risks. While some people seek their fortune on the stock market and make big profits through clever investments, others are faced with the ruins of their financial existence because they got involved in dubious deals. The financial crisis of 2008 has shown that there is an urgent need to strengthen the regulation of financial markets in order to ensure the stability of the financial system and protect consumers from unfair business practices. But what does effective regulation look like? And who are the actors working to make it happen? In this video, we will explore the exciting world of financial regulation and why it is so important. Let's start with 13 facts about financial regulation. Financial regulation aims to ensure the stability of the financial system and protect consumers. Regulators are responsible for establishing and enforcing rules and regulations for financial institutions. Financial regulation is a complex and comprehensive subject that covers many different aspects such as banking regulation, securities regulation, and insurance regulation. Some of the most important regulators at the international level are the International Monetary Fund, the IMF, and the Bank for International Settlements, BIS. In the US, there are various regulatory agencies such as the Federal Reserve, the Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC. In Europe, the European Central Bank, ECB, is responsible for overseeing financial stability. Financial regulation has changed significantly in recent decades, particularly in the aftermath of the 2008 global financial crisis. Financial regulation can also have an impact on the economy, as it can affect growth and investment. However, regulation can also contribute to greater stability of the financial system and protect consumers. Financial regulation affects not only banks and financial institutions, but also other companies that trade in financial instruments or provide services. Regulation can also vary internationally, which can lead to companies in different markets being subject to different regulations. There are also controversial debates about how strong financial regulation should be and whether it can impede economic growth if so. Overall, financial regulation is an important part of the financial system and plays a crucial role in ensuring stability and protecting consumers. The Dodd-Frank Act was introduced in 2009 to regulate banks more closely and stabilize the U.S. financial market after the 2008 global economic crisis revealed various problems with deregulation of the financial market. President Donald Trump has restricted the law to facilitate lending and lower costs for smaller banks. The Federal Reserve and other agencies are working to further deregulate the banking and financial sectors. This leads to concerns that a spiral of deregulation could occur, which in turn could become dangerous. However, it is not easy to answer the question of the right degree of financial regulation, as government regulation must combine two competing goals. The high degree of globalization creates a relationship of dependency between countries. As a result, a market economy must remain competitive in the international arena, which can be achieved, for example, by making capital available to companies cheaply and easily through a low level of financial regulation. On the other hand, a state also wants to prevent a financial crisis in any case, which can be controlled and achieved by different factors of financial regulation. Several questions derive from this. Who is specifically responsible for a financial crisis? Should banks be bailed out in the event of a collapse? How are people or companies punished who do not comply with the regulatory framework? There is no country with a complete lack of financial regulation. Every country has some form of regulation for its financial sector. However, some countries have less regulation than others. Some countries that are considered particularly regulated include Switzerland, the European Union, and Japan. Some people are opposed to financial regulation because they believe that regulations limit competition and inhibit growth. Regulations can be costly for companies, as they must allocate resources to regulatory compliance and reporting requirements. In addition, regulations may be disproportionate and put companies that comply at a disadvantage compared to competitors that do not. Some people argue that regulations inhibit innovation because companies that develop new ideas must comply with a variety of regulations. So there are several reasons why some people oppose financial regulation. The level of regulation depends on many factors, such as capital requirements. Banks and financial institutions must hold a minimum amount of capital to cover credit risk. Disclosure requirements. Banks and financial institutions must regularly disclose their financial data and risk. Regulations of products and services. Regulators can regulate the approval and supervision of financial products and services. Supervision and oversight. Regulators can monitor banks and financial institutions and penalize inappropriate practices. Restrictions on risky business practices. Regulators can require banks and financial institutions to restrict or avoid risky business practices. Risk management requirements. Banks and financial institutions must establish internal controls and risk management processes. Stress tests. Regulators can require banks and financial institutions to conduct regular stress tests to assess their ability to cope with financial stress. U.S. President Donald Trump saw financial deregulation as one of the most important means of boosting the U.S. economy. In his view, the heavy regulation imposed by the Dodd-Frank Act, which was introduced after the 2009 financial crisis, hindered lending and thus hampered economic growth. Restricting the Dodd-Frank Act was intended to make it easier for smaller banks to lend and reduce regulatory costs. Deregulation also had the benefit of giving U.S. banks greater flexibility through reduced stress test requirements and other regulations. This could lead to better lending and an increase in the supply of credit, which in turn could boost the economy. In addition, deregulation could also help U.S. banks become more competitive with banks in other countries that are under greater regulation. For example, the German banking industry warned that German banks could lose out to U.S. competitors. In summary, Trump saw financial deregulation as an important tool to boost the U.S. economy and make lending easier, resulting in lower costs for smaller banks and increased competitiveness for the U.S. banking industry compared to banks in other countries. If you like this video, we appreciate a thumbs up and you subscribing to our channel. A high level of financial regulation comes with some disadvantages that can be offset by deregulation. Regulations can add costs to financial institutions that they must pass on to consumers, which can increase the price of financial services. Regulations can inhibit progress and innovation in the financial industry by making it more difficult to deploy new technologies and business models. In some cases, regulation can be excessive and unnecessarily complicate or impede trade, which can lead to inefficient markets. Regulations cannot cover all risk and are sometimes incomplete or not up to date, which can lead to gaps in oversight and protection of consumers and market participants. Despite these drawbacks, however, regulation is necessary to maintain confidence in the financial sector and protect consumers and the market from harmful practices and risks. In addition to the benefits Trump saw for his own country in reducing financial regulation, however, low financial regulation can also have disadvantages for a broad segment of the population. Low financial regulation can lead to a number of disadvantages. These include the increased likelihood of financial crisis and economic instability. Without sufficient regulation, banks and other financial institutions can engage in risky business practices that can lead to massive losses and even bank failure. Low regulation can also lead to a distortion of competition, with larger and well-regulated firms being crowded out by smaller and less regulated firms. In addition, low regulation can lead to consumers and investors being poorly protected and their savings and investments being at risk. Overall, then, low financial regulation leads to an uncertain and unstable economy that affects businesses as well as consumers and investors. In the U.S., financial services and products are overseen by several regulatory agencies, including the Securities and Exchange Commission, SEC, the Commodity Futures Trading Commission, CFTC, and the Federal Reserve System, Fed. The regulations aim to protect consumers from fraud and unsafe practices to ensure a stable financial market. Regulators in the U.S., such as the SEC, CFTC, and Fed, have an important role in overseeing the financial market. Their main tasks are to protect consumers from fraud and unsafe practices and to keep the financial market stable. The SEC oversees the capital market and ensures that companies listed on the exchange are transparent and responsible to investors. The CFTC regulates trading in commodities and futures and ensures that markets operate fairly and efficiently. The Fed regulates and supervises the operations of banks and financial institutions to ensure that they are safe and sound. In addition, the Fed is charged with controlling inflation and ensuring the flow of money through the economic system. Regulators work together to protect consumers from fraud, faulty practices, and unsafe investments. Regulators monitor the financial system as a whole to identify and manage potential risk and problems. Regulators enforce regulations by imposing penalties for rule violations and taking action against firms that violate regulations. In summary, it is not easy to answer whether high financial regulations comes with more advantages or disadvantages. On the one hand, high financial regulation can strengthen consumer and investor protection and contribute to a safer and more stable financial industry. It can also create a fairer competitive environment, as regulations can constrain large and powerful firms and create small and medium-sized firms. On the other hand, too much financial regulation can limit the flexibility and efficiency of the financial industry and increase costs for banks and financial institutions, which can negatively affect their profits and the economy as a whole. It can also cause banks and financial institutions to move to countries with less regulation, which in turn can lead to job and investment displacement. Smaller companies, in particular, may struggle to provide the resources and staff to meet the demands. This can make companies less competitive and less able to invest in their businesses to grow and expand. Financial regulation may be a dry subject for many people, but it is crucial for the stability of our financial system and thus for the economy as a whole. Without regulation, we would be exposed to a wild, uncontrolled market that could lead to unstable financial bubbles and ultimately even the collapse of the financial system. Financial regulation is therefore not a necessary evil, but an important prerequisite for sustainable growth and prosperity. It is our responsibility to ensure that regulation is sufficiently strong and effective to guarantee the stability of the financial system. After all, this is the only way we can make long-term investments and maintain confidence in our financial markets. That was today's video on financial regulation and deregulation. What are your thoughts on the level of financial regulation needed? Thanks so much for watching.